Well, good afternoon, everyone. Thank you so much for turning to our video presentation for this class project Paris. And I'm excited to kick off this exciting group adventure. And this is truly a team assignment. And we are proud to share our collaborative analysis on crafting an optimal investment portfolio and strategy. I'd like to take this opportunity to spotlight our incredible team. 郑渊、赵敏、江一宁、林宪实、关宇、王浩辰, and myself. Together, we've harnessed powerful tools like optimization and decision modeling to tackle a dynamic real-world investment puzzle. Picture this: our client is a vibrant young investor with medium risk tolerance, ready to invest $1 million USD over a 1-year horizon. As a sharp investment managers at Citibank, our mission is to build a portfolio that maximizes returns while respecting risk constraints. The core question: how to allocate that capital across four assets for the highest 1-year return, balance high growth thrive with solid stability. Our diversified assets, including Asset A, the low-risk Gaoten Wei Fund USD money market fund, Asset B, US long-term treasury, also with low risk, Asset C, the high-risk Dacheng China flexible allocation equity fund, and Asset D, E fund Hong Kong Nasdaq 100 index fund for tech-driven gains. This mix blends stability and growth potential perfectly. Why does it matter? Because a data-driven approach skips guesswork, delivering justifiable strategies aligned with client goals. All right, with the stage set, I will pass the spotlight over to my teammates Ning and Zhang for a deep dive into our data source and methodology. So thanks for hanging with me. Keep watching, and the best is yet to come.
So I will talk about data and methodology. So for our analytical approach, we use linear regression programming model. So we have to find the best allocation of return for these four assets. We mainly have to focus on how to build this portfolio within a 1 million range of assets within a certain bounds. And the next page is our main objective, as I just mentioned. And we get our data resources from the Huasheng Group Wei Brokers and the Bank of China Hong Kong Mobile Banking, CMB Winlong Bank's fund section. For our expected 1-year return, our assets A to D is 4%, 4.6%, and 73%, and 9.6%. And to reach our main objective, we have to focus on two mainly rules. One is asset diversification, and another one is moderate risk. And I will pass my route to.
Now, we are going to abstract the real-world problems into mathematical expressions. To begin with, we start by defining our decision variables, which are the investment amount in four assets, A, B, C, and D. And our primary goal is to determine the amount of money allocated and maximize the investment return. So the create objective function equal to the expected rate of return of each asset multiple the corresponding invest amount. And the mathematical, we needed to do some constraints. To begin with, the total investment amount should less than 1 million, but we need also to use each cent of the money. So the four assets should equal to 1 million. And we also need to diversify and concentration the portfolio. So we hope to our portfolio, each investor of the portfolio less than 300,000 and more than 100,000. And we also need to control our risk because our clients need to control this kind of risk not to be so high. So the amount of money investment in high risk asset C and D should less than 500,000. And now we can use the Excel to solve this problem. Since we have already specified the formulas of the objective, now we can set up the framework and enter the data in Excel. In order to use the solver, we need to set up constraints. So apply the solver and we can get the conclusion as our result. And my partner Tang Zheyuan will introduce the analysis of this conclusion.
I'm really excited to share the results of our investment strategies analysis. First off, we found that the maximized expected return is about $103,000. This is the highest potential profit we can aim for, given our investment guidelines. Plus, our overall portfolio yield is sitting at 10.32%. Here is our investment plan. We will put $200,000 into asset A, $300,000 into asset B, $300,000 into asset C, and $200,000 into asset D. This smart spread helps us diversify while sticking to our silent investment limits. Now let's talk about the interpretation of results. The model really favored assets such as China thanks to its impressive 20.73% return. So we allocated $300,000 there to maximize our gains. We also made sure to take advantage of our high-risk capacity. That's why we put $200,000 into asset D, Nasdaq 100, which fits nicely within our $500,000 high-risk cap. It's all about balancing risk and reward. What's more, we have got $300,000 in asset B, US Treasury, which contributes a solid 4.613% return to our overall yield. And to wrap it all up, the remaining $200,000 was placed in asset A Gaotem MLF to meet our total investment goal of $1 million. This keeps our commitment with all the rules while aiming for the best returns possible. In short, our analysis has led us to a well-rounded investment strategy that balances both risk and rewards. Thanks for listening, and my partner Wang Haochen will take it from here.
To the analysis part, the first question we point out is which constraints are active, and now we have an idea wants to tell the audience is that a binding or active constraint is one directly limits the objective. Our optimal solution is shaped by the key boundaries, constraint status, and these active constraints are identified in the answer report by having the slack value of 0. And if you look at the chart here, you can see the total investments and the high-risk capital are our key factors, and which provides higher return. And it means the model utilizes the full capacity and high-risk assets and the entire budget to maximize the return. There are also some inactive constraints you can see here as the SSA min-max and XSD min-max. It exceeds the requirement limits. The two active constraints that control our optical investment strategy is the high-risk limits and the total budget. To achieve the total return, we should focus on relax or adjusting these two specific rules. So after we analyze the answer report, it comes to the sensitivity report. And first, we have to know the value of the linear programming. Linear programming is not just the answers, but understand how it comes. So it is really significant. We should also analyze the sensitivity report. And before we start that, we have 4 key questions to point out, which is how much would our returns change if we could relax a rule, and how confident are we in the allocation if our return forecasts are slightly off, and what is the cause of our constraints. And for that, I will bring it to my teammates Fanny to tell you more.
Now that we have our optimal solution, the real value for the client comes from understanding why it's the optimal solution. This is where our sensitivity analysis becomes so powerful. Our first and the most critical material insight is the value of the client's high-risk cap. The model tells us that the 500 million limit on high-risk assets is a binding constraint, meaning it is actively limiting our ability to earn a higher return. The shadow price for this constraint is 0.06517. In simple terms, this is the price of the client's risk tolerance. It means for every additional dollar, the client would be willing to allocate to high-risk assets. Our portfolio's total return is projected to increase by about 66.5 cents. This gives us a clear data-backed number to discuss the risk-reward comfort level. Second, we wanted to know how confident we should be in our high return bet on SSC. The Dacheng China Fund, we allocated the maximum 300,000 to it because of its high 20.73% return. The sensitivity report shows an allowance decrease of 11.13%. What this means is our forecast for SSC would have to be wrong by a huge margin for this decision to change. Its return would have to fall all the way from over 20% down to 9.6%, the same as SSD, before the model would even consider reducing that 300,000 allocation. This shows our allocation is extremely robust and not based on a fragile forecast. Finally, gave us insight into the role of our low-risk assets. The shadow price for our total $1 million investment constraint is 0.04613. You'll notice this number is exactly the expected return of asset B, the U.S. Treasury. This isn't a coincidence. It confirms that the model's logic. It tells us that if the client gave us the extra dollar, the model's first choice would be to replace it in asset B, the highest yielding asset that isn't already maxed out by another rule. These insights show that the LP model is not a black box. It provides clear, justifiable, and actionable guidance we can use to manage the client's portfolio effectively. Now I will let Zhao to give the final project conclusion.
And this brings us to our conclusion, where I'd like to summarize the key findings of our analysis. First, the problem. We were tasked to allocate a $1 million portfolio for a medium-risk client and to a special set of rules for diversification and risk exposure. Second, our key insight. The sensitivity analysis revealed that the client's self-imposed 500,000 cap on high-risk assets is the single greatest limiting factor preventing high returns. Third, the model. To solve this, we implement a linear program DOM. This analytic approach allowed us to find the mathematical optimal solution. Fourth, the optimal allocation to achieve the return is precise. 200,000 in the money market fund, 300,000 in Australia, the same in the Dacheng fund, and 200 in the Nasdaq fund. Finally, the optimal solution. Our model determined that the maximum possible return under the client's rules is about 103,000, 10.32% annual yield. This project has been a practical and powerful application of the core principles from our course, Business Analytics and Design Modeling. We were tasked with a complex, real-world business challenge. By defining the problem, structuring the data, and applying the LP model, we were able to find an optimal solution. This process clearly demonstrates the power of decision modeling to solve practical workplace problems, providing clear, data-driven, and actionable insights. Finally, we would like to extend our sincere gratitude to Professor Kevin for his insightful guidance and support throughout this project. Thank you.